an interesting gold tax loss strategy. Buy when there is blood in the streets. We've all heard this cliche, and unless you're a vampire, most avoid blood. So how does one benefit from the blood in the streets concept? By paying attention when the markets get hit with a large volume of sellers who need to head for the exits for tax loss or other purposes. This is how Christmas can come early for investors who are prepared. I've been both a victim and benefactor of tax loss selling. So in today's missive, my goal is to help present how to go about tax loss selling to benefit and learn from my mistakes and successes. There is no doubt investors selling in a panic is a great way to find cheap prices for great stocks. And that means opportunities to make hundreds of thousands, even millions of dollars in extra profit. Here's what happens. At the end of every year, investors and speculators start looking at their portfolios and formulate plans to reduce their tax bills. Remember, balance the gains and losses and pay less to Uncle Sam. All of that's legal. This means deciding if positions should be held to get short-term gain tax treatment or long-term gain tax treatment. But more often than not, it means deciding to sell stocks based on factors that have little to do with the underlying values. If you've read my work for a while, those words should trigger your interest. You know that most of the time, the market places the correct value on assets, but not all the time. As investors, we find our edge during those rare times when buying and selling decisions are not based on values, dividends, or cash flows, but instead on external factors like fund redemptions, tax considerations, or fear for the world is about to end. These periods are one of the only times that intrinsic value seriously decouples from share prices. In other words, when selling decisions are based on factors that have little to do with underlying values, we, the patient alligators, can strike and pick up assets for bargain prices. The tech sector, precious metals, and crypto have all been decimated. The energy sector is among the only major gainers of the year, and even they are limping lately. This is exactly what happens at the end of a brutal market year like 2022. Investors dump stocks simply to lock in losses or gains because their upcoming tax bill is first and foremost in their minds. Also, in certain countries like Canada, you can go back a few years and offset your gains with losses in the current year. Our team conducted a plus 25-year analysis of tax loss selling in the gold market, and that's our focus today. It is a well-known strategy to sell unprofitable positions and use those capital losses to offset capital gains elsewhere. This can lead to crowded trades where many investors are heading for the exits just to take the tax loss. Buying these dips on the right companies for trades has the potential to be a sound strategy if executed correctly in the right stocks. Remember, garbage in is still garbage out. The Gold Bugs Index is an index composed of about 100 plus stocks dating back to the 1995. This provides us with 27 years worth of tax loss data to analyze. So we built a visual, which is the chart you're looking at right now, going back to 1995. This is what we call the Gold Bugs Index. This chart shows the average monthly returns for the past 20 years for this index. So we broke it down by the monthly returns average for every month. So January over the last 20 years, February over the last 20 years, March over the last 20 years. And what you should be focusing on is January, because look at that 4.1% over 20 years average for that month. Well, why is that? Because of heavy tax loss selling in December. Now, let's devise a tax loss trading strategy. This is what we presented to our Katusa resource opportunities in early November. The tax loss strategy is very simple. Buy in November, which is typically around the time when tax losses are starting to be harvested. And then you sell in the first trading days in late January or February the following year. Dates can be adjusted, but this provides a good proxy to understand the mechanics and potentials of capturing profits based on tax loss sales. The next table you're looking at shows the results of this buy in November and sell in February approach. The simple strategy beats the S&P 500 and gold, both over the whole period. That's over 20 years, and in years where gold's performance is negative leading up to the tax loss date. So Doing this tax loss average from all years, you can see that the gold bugs, buy in November, sell in by February, outperforms gold bullion and the S&P 500. Pretty impressive. With this data in hand, I will continue to watch the market for potential tax loss candidates. A key determining factor will be if the company has enough volume to handle both large amounts of buying and selling. Remember, any liquid stock, please stay away from, because this strategy would not work. There will be many smaller liquid juniors who will get hammered into the end of the year, but taking advantage of those types of opportunities with the size is the next to impossible. While there may be enough volume to get in, getting out is considerably harder. Remember the whole Hotel California, you can check in, but you can never check out. And that leaves you at the whims of the company and its catalysts and their promoters, who are usually full of hot air. Keep cash in hand and don't get scared with any increase in volatility. That's when multi-year fire sales happen and you stake your bids for multiples on your money in the coming years. You want to target real businesses making real cash flow in an era of higher rates and slowing economy? That's what I'm doing. Stay safe. Subscribe to the KRO, which is a Katusa Resource Opportunities, to find out exactly what prices I'm buying at and what price I sell at before the trade occurs. And you get to sell before I do. If you want to give your portfolio an edge, consider becoming a member and giving it a try for yourself.